A second mortgage is a loan you take out against the equity you have already built in your home. Equity is the portion of your home that you truly own, calculated as the market value minus your remaining mortgage balance. Most lenders require you to keep a significant buffer of equity, rarely letting you borrow past 80% of your property value. You typically choose between a fixed lump sum loan or a flexible line of credit, often called a HELOC. The primary mortgage is paid off first if you sell the home, which is why second mortgages often carry higher interest rates. Because the second mortgage is subordinate, the lender takes on more risk, which is reflected in the loan terms and costs. Remember that your home is the collateral for both loans, meaning failure to pay either can put your property at risk. Second mortgages can provide liquidity, but they increase your total debt load. Always compare rates and terms before committing.